In this video, guys, we are going to look at the inside day breakout trade. Stay tuned. Hey traders, welcome to. So I've got a simple setup for you, simple trading strategy that you can use on any market, your currency pairs, your commodities, your indices, stocks, whatever. It's the inside day breakout trade. So first of all, what is an inside day? So an inside day is basically when the subsequent day or the next day, the range is within the prior day. So let me have a look at it. Let's have a look at it. So we've got a bar here, same as a candle. The high is the high, the low is the low, and the open and close. And depending on which position they're in or which side they are, is the open and which side they close. Unlike a candlestick, where the color of the actual candle denotes the open or close, in a bar, we've got the open on the left and the close on the right. Anyway, it could be either or. You can use candlesticks as well, just for illustration purposes using bars. So there's the high, there's the low. That's the range of day one, if you like. On day two, what we want to see is that the high is below day one's high and that the low is above day one's low. So in other words, you can just see, guys, visually it's much easier to see it, that the bar is kind of just really inside the prior bar, which is why it's called inside day. Okay, so what we're really doing here is we're saying, okay, it's a period of indecision. It's a period of like no one's really made a commitment, haven't really broken out from high or low. And so the idea is, under the right conditions, which we'll cover in a moment, it's a good place to expect some kind of breakout strategy or some kind of breakout in momentum and price. And so the rules are pretty simple. We can flip them on its head for the short side, but for long, in this scenario, let's imagine we've kind of got a little uptrend here, and here's our inside bar or inside day. So you can see that it's really not broken out of the high or the low of the prior day, whatever market we're looking at. Now, what we're trying to do here is we would be going long above the high plus a few ticks. Now, that few ticks is going to depend on a few pips, depending on what we're trading, is going to depend on the market you're trading and the volatility. But as a rule of thumb, generally, if, say, the range of the bar was 100 pips, you would say something like plus 10 pips. So maybe 10% of the range, maybe a bit less. You know, again, this depends on the volatility, depends on what you're expecting. But what you don't want to do is to be jumping in if the market has a history of just breaking through highs or lows by a few ticks, few pips, and reversing. Allow for that. Give yourself a little bit more room. Better to not be triggered in and be a little bit than be triggered in and getting pinged out. So long above this high on the next day plus a few ticks. And then what you're trying to do is you'll want to just hold it for one day. That's it. That's it. All the trade is a 1 day play on a break of the inside bar. And what you're saying is, hey, that was a little bit of an indecision bar. I'm going to now go long about here, it would be, just above it, and wherever that bar then closes, I'm going to take it. So it's literally taking a small chunk of the move and riding that momentum wave. Done. That's all you're doing with this trade. It's a very simple setup, and on the right conditions we'll look at a moment, it's very good. So, and the stop is under the bar low. Now, you might say, well, does that ruin the risk reward ratio? This is just a guide, because sometimes if that bar is relatively wide, you don't know where your target is, it is what it is. But the thing is with this is the probability of it working is quite high, so it might not suit you because the risk reward ratio, you don't know what the risk is, you don't know what the reward is going to be because you're literally closing on the close. That could be 10 pip profit, could be 500 pip profit, you don't know. So it's hard to gauge and judge sometimes, but it's something to work off and something for you to tweak and adjust to make it your own strategy. So you're going long above, you're going to close the trade on the next bar close, or should I say this bar close. So if that's day one, that's day two. Day three is your trigger bar. You're going to close the trade on the close of that trigger bar. Now, there are some additions to that rule, and you could say that if you don't close below your stop, you hold it for the next bar. That's up to you. I personally just want to see it close on that. And if it doesn't, it doesn't. If it closes just below here, then you take your loss and you move on. If it stops you out intraday, you take your loss and you move on. If it closes above the high, then great. You take the trade, you bank the trade, you move on. Now, if you want to add some rules to allow you to run the trade for multiple days, that's entirely up to you. And I wouldn't be against that if that was something you wanted to add into it. Okay, so you can see why we're doing this. Now, situations where this would probably work best than others, we don't want it to be in a range-bound environment, because if it's in a range-bound environment, we're probably going to find it's testing highs, testing lows, and always going to be faking you out. Trending environment's going to be a bit better. So this sort of position here, good uptrend above the moving average, and get that inside day after a good day, and then we take it for a subsequent move. So it's a nice thing to wait for. Ignore it in a range environment, take it in a trend environment, try to stick with the trend. In other words, you know, there is argument to say that you go short under the low of a inside day, wherever it is. So you put a buy stop above the high to get in, put a sell stop below the low to get in. You could do that, and I think that's fine, but you could add an extra bias and say only take long trades in an uptrend or only take short trades in a downtrend, or whatever it may be. So you can add one or the other rule to it, but traditionally you can say, okay, well, you know, I'm just going to take a breakout of that and expect that that is the one day. Don't forget, you're going to get one day on this deal. You know, it's a one day, hey, it's broken, it's rallied, it's had a big extension, it's now consolidated today. The next day we're going to look for a continuation of that. So you're really looking for the break of the high to the close. So it's only a very small window of opportunity. So if you want to play counter trend, I could see fine why you do it, but if you wanted to play extra cautious, you might want to stick with the trend. All right, guys, that's the inside day breakout trade. Stick around. Also, I say subscribe to the channel if you haven't yet, and in the comment section below, much appreciated. And if you haven't checked out our channel sponsor, there's a link to those guys in the description below. Take care. Bye bye.